Welcome to Monday's Market Outlook here at Top Gun Options. My name is Matthew Buckley. My call sign is Wiz. Hopefully you had a great weekend. We had a great week last week here at Top Gun Options with our Options Weapons School. Got all of our 25 slots full, and we're getting ready to get airborne here at 1 o'clock with our weekly options live trade brief. I had a good weekend. Said goodbye to my my three junior officers today. They left on deployment, so to speak, on a Disney cruise. Had a great weekend. Good as Sunday fun day with Jack and Keely, and then got to teach my daughter Keely how to snorkel before they left for their Disney cruise today. So I'm going to miss them this week. But we got a lot to do. China. Looks like we were pretty damn good with our call on China about 2 weeks ago. I said, hey, I'm bailing out of my FXI positions. Good headline here, maintain 6.9% economic growth. But as I always say, folks, if you can dictate economic policy at the end of a bayonet, you're most likely going to hit those numbers in the Bureau of Numbers, comrade. Beating expectations as Beijing walks a tightrope. Why? President Xi Jinping freaked the hell out of the markets this week. The Shanghai had the biggest daily decline in 7 months. What did he do? He said, we're going to grow up, folks. We need to, 5 years ago, one of the reasons I got bullish on the FXI years and years ago was because how bullish they sounded, an open market, and all sorts of stuff 5 years ago. Well, over the weekend, he said, yeah, we're going to grow up. We're going to sit on reining in our debt levels and announce the formation of a committee to coordinate financial regulation. Ooh, that really was in stark contrast to the last meeting when 5 years ago, which advocated reforms that would bring China's markets more in line with global peers. So what was interesting is the central bank had to get involved. The Central Bank of China, People's Central Bank, the PCB, it injected 140 billion yuan. That's about nearly 21 billion US dollars to stabilize it. And guess what? If they were that quick to jump in to save their form of capitalism, they kind of knew that this guy's words were going to freak the markets out. So this is interesting that, again, a central bank gets involved to prop up and give everybody a participation trophy. That's not a good thing, right? And here in the United States, we got our own problems with the central bank propping up our markets here. So we're a little unched. Last week's Rip Your Face Off. Check out all these after we drop, these pops are followed by either sideways to down. Look at this. Here's the Comey memo. Rip your face off rally after that and sideways. Here's the healthcare implosion sideways, another kind of melt up here. We got way over our ski tips last week, folks. We covered this repeatedly about how Janet was way, way, way dovish last week. And check this out. Last week, the Fed funds futures rate showed a 59% probability of an interest rate interest rate increases through the end of the year. Now it's 48%. So Janet did exactly what she didn't want to do last week, which was, first of all, talk the market up and lower the potential probability of interest rate increases. Now, I listened to the testimony. They didn't cover it on Thursday because I think if they had covered a little bit more live on Thursday, the markets would have kept melting up here because, a couple of their lieutenants went out last week. Brainerd tried to go out and say, hey, asset valuation is a little too high, volatility is a little too low. Nobody listened. Nobody listened to the Fed lieutenants, and the market still went up. Stocks are about to make Dudley, Fisher, and Yelleon extremely nervous. Why? Just because of that, folks. We're having this melt-up rally. And let me ask you real quick before I give you the answer. My members know this. Who was the #1 buyer of the S&P 500 for the past 1.5 to 2 years? If you said the S&P 500, you're right. And now if I asked you who's been the #1 buyer of the S&P 500 year to date, you'd fill in the blank with the same answer. There has been just one buyer of stocks since the financial crisis. I asked this on Friday, guys, in our weekly options debrief. Got blown out of an Apple and an SPX iron condor just on you couldn't talk this market down. Friday morning, we had bad macroeconomic data, mixed bank, mixed financial. We got Goldman Sachs tomorrow. And we also had an unhinged liberal Jamie Dimon more or less announce his presidency, but I digress. But, guys, you can't keep this market down. You know why? And I said, folks, I know no hedge fund manager that I speak with, no guy who's managing a lot of money or anybody who's swinging a lot of capital in this market who's getting long. And I answered my own question of the who's getting long. The companies in the S&P 500 are still buying back a ton of shares. Now imagine if we get some tax reform out of Trump. which I'm a seller of because we can't even repeal and replace Obamacare. Again, I digress. But folks, could you imagine if Apple gets to repatriate 250 quadrillion of their dollars from County Cork, Ireland? What the hell that could do to their stock price? It could blow it through the roof. Why? Because they're going to buy back their shares. So, and we know, I'm not going to give you an economics lesson in our Monday Market Outlook here, but folks, we know that artificially inflating the P of a company through share buyback doesn't do anything. One of the main reasons that executives like to buy back their own shares is why. In case you didn't know, a lot of executives' compensations are tied to what? The share price. That was a good idea years ago. Like, well, we'll incentivize the CEO to make the company do better. The dude just turns around, or the lady, and buys back their shares. Ain't exactly incentivizing anybody. So we're in a very, very precarious position. And like I said, you know, I love this picture, you know, this car out on a ledge here. Stocks are about to make the Fed lieutenants and the skipper very, very nervous, okay? And we talked about the University of Michigan consumer confidence number on Friday, the lowest since before the election. Macroeconomic data aren't good. We're just in the beginning of earnings. We'll see how good or bad they get. But, folks, I got to be honest with you. It's very, very, very interesting that we're at these levels, okay? I would not be a buyer here. I wouldn't necessarily short this because the market can remain irrational longer than you can stay solvent, okay? So have a great rest of your day. Happy hunting. Make sure you hedge, and I'll see many of you in our weekly options live trade.